Hi viewers, welcome back to Options Wisdom. I hope you all are doing well. Regular income option strategy series we are designed in such a way that our viewers can learn every detail like theory behind the strategy, deployment and margin required and how to reduce the margins and also ideal time for deployment and adjustments. And finally we are showing the deployment and adjustments in a live using the option simulator. Okay, friends. Hi friends, in our regular income option strategy series, in this video we are learning about double ratio spread and the other details. Our agenda is learning the theory and logic behind the strategy and rules for deployment and margin requirements and rules for adjustments and live deployment and adjustments using the option simulator. What is the theory? What is the ratio spread? The ratio spread involves the buying a call or put option at the ATM or OTM and then selling two or more of the same option further OTM. Suppose the ratio spreads are two types: call ratio spread and put ratio spread. Suppose call ratio spread is there. In call ratio spread, what we are doing, buying one option contract of lower strike and simultaneously selling two option contracts. That means if you buy the one ATM strike price and sell two OTM strikes, it is a maintain 1:2. If it is 1:3, buy one option contract of lower strike and sell three option contracts of higher strike in call ratio spread. Like that, put ratio spread also. Buy one option contract at the higher strike price and simultaneously sell two option contracts of the lower strike price. It is a 1:2 ratio. Suppose if you see, for example, if a call ratio spread you take one 43,900 CE, it is a one call option I bought. It is a lower strike price, and two call options I sold. It is a higher strike price. Approximately, we have to check that the premium of what option should be equal to the ratio. So such that means if it is a call option price is 360 rupees, the sold option should be around half of this around 180. We should look like that only. In put option is also similar. Put option is buy one option contract of the higher strike price, simultaneously sell two option contracts at lower strike price, maintain 1:2 ratio. For this example, I bought 43,900 PE ATM option and I sold 43,400 PE OTM options, two OTM options. ATM option premium is 348 and OTM option premium is 178. Approximately, the premium also should be 1:2 ratio only. Suppose it is 348 means half of 348 is 174. This is the 178. We should see that it should be two premiums. It is two contracts of out of the money put options we have to sell. The sum of these two options almost near to this one. We should see like that. Okay. This is regarding call ratio spread and put ratio spread. When we are deploying this call ratio spread, when we have a fear of lower side, and underlying is moving higher, when underlying is already move up to some extent and we have a fear of lower side, In those situations, we are deploying this strategy. It is a little bullish and having a fear of fall. When we are doing this put ratio spread, when we have a fear of higher side, it is already in lower side. When we have a fear of higher side, and it can move up to little bearish. It has a our forecast is little bearish movement. In that situations, we are deploying the put ratio spread. These two are directional. Okay, friends. We will go to our strategy. What is our? We are combining this call ratio and put ratio spread, and we are making the double ratio spread. This is the double ratio spread. What happens in double ratio spread? The trader buys one call option and sells two call options at higher strike price, and also buys one put option and sells two put options at lower strike price. You see here 43,900 PE, and I have combined the two. You have seen no previous slide. I have combined those two. It became a double ratio spread. What is our benefits? Double ratio spread. We will get the theta decay of the option contracts as well as any contraction in the implied volatility. Any contraction in implied volatility, the strategy benefits when the stock price remains relatively stable and stays within the range. If stock price stable and stays within the range, if it is used in range bound markets. Actually, we'll think stock will not go. This underlying bank nifty will not go around 500 points higher or 500 points below. It will be within the range of 1000 points or within the range of 1500 points. In those situations, we are deploying this strategy. Okay, friends. And what are the rules for deployment and margin requirements? We can deploy this strategy on Thursday or Friday after 2:30 p.m. is the ideal time. Actually, the margin required is actually we require the margin. Actually, the only we are selling the 2 contracts. No, that is the margin requirement is high. Actually, it is required 2 lakhs. 2 lakhs, but we can reduce it to 1 to 1.5 lakhs by buying the small premium hedges. Like if you see here, we can buy another small premium, around 10 premium hedges, 10 PE premium 1 heads and 10 premium CE heads 1 heads. If we buy, then it will reduce to 1.2, 1.1 to 1.2 lakhs. We can deploy this strategy in Nifty and Bank Nifty also, and those two underlying options contracts we can use. Okay, friends. Next, rules for adjustments. What are the rules for adjustments? You see here, I have marked 2 points here. This is one cliff and this is one cliff. This is the cliff points. See, this is the underlying. Now underlying is 43,880. Suppose if this underlying reaches any of this cliff, either lower side or higher side, any of this cliff. You see here, what are the break evens? 42,890. If it underlying comes to this cliff, we have to buy 42,900 PE. If underlying comes to this cliff, we have to buy 44,700 CE. Only that adjustments we have to do. And we will know after doing that adjustments what will happen. We will know in live deployment and live adjustments when we see in option simulator. Okay, friends. Okay, friends. Hi, friends. This is the StockMock application where we are simulating our strategy. with a option data, and also we are back testing. We will back test at least 4 expiries. We'll go to the simulator, and this is May month, no? All this 4th of May, 11th of May, 18th of May, last 4 expiries, we will back test. Okay, friends, let us start. On 4th Thursday, no? 4th one, and we have to start in April 28th, Friday. Okay, friends, what is our time? 14:45. Ideal time after 2:30, it is 14:45. What is our strategy? At present the spot price is the Friday, April 28th, 14:45. The spot price is 43,066. So the ATM price is 43,100. So these are our ATM strikes. We will buy the ATM strikes on one lot, and our ratio is 1:2, and we will sell at least half of this, means 250 means 125, nearby 125, it is 132. We will sell 2 lots of this. Okay, friends. Next, we'll sell the call also. 218, no? What is the nearby price? 100. We will sell 110, it is there. Here it is 130. So nearby is 100 only. We'll sell the 2 lots. Okay, friends. So it is a double ratio spread. This is our strategy. Now we are going to start simulate our strategy by 30 minutes. Okay, friends. These are the break evens. You see, 42,500 to 43,695. At around 1200 points break even is there. 1200 points. So we'll follow our adjustments rules. Whenever the whenever our market goes this break even, will exit the strategy, and this break evens, when market crosses this break even, will exit the strategy. Okay, friends, let us start. Oh, market already crossed this cliff. What is our rule? 1 minute, friends. What is our rule? 1 minute, 5 minutes. We'll go by 5 minutes. 5 minutes. Whenever it crosses the cliff, what we have to do? We have to buy. We have to buy 408. No, this cliff we are crossed. So we have to buy this break even call. Break even. What is the break even point? 695. 43,700 call we have to buy. 43,700 call we have to buy. One lot. Okay, friends. Then it will. You can observe this. No, we can. It is no risk. If it is market moves still higher, there will not be risk. Will be less. Okay, friends. Then we will start again simulating. 30 minutes. When market comes back again to the center, that time we will sell this call. Okay, friends, as per our rules, strategy rules. Tuesday, already 2 p.m. to 25 p.m. Tuesday, already 3 p.m. We are in profit of 100 rupees. Tuesday, end of the day, end of the market hours, 3:25. We are in the profit of 245 rupees. And Wednesday morning, 9:30, 9:40. We are in the profit of 600 rupees. 10 o'clock, and by 30 minutes we are going. Wednesday, 12:40 p.m. We are in the profit of 700 rupees. Our capital is 1.2 lakhs with the hedges. Okay, friends. When we get 2%, it is a 2,400. When we reach, we will exit the trade. And also, whenever we cross these break evens, that time also we will exit the trade. Okay, friends. It is almost Thursday, 10 a.m. We are in profit of 1566. Thursday, 10:50. Thursday, 11 a.m. Thursday, Thursday, 12 p.m. We are in the profit of 2000. And also Thursday, we are going to exit the trade before 2 p.m. 2 p.m. we have to exit the trade. Okay, friends, that is also our rule. After 2 p.m., what happens? Market will become very volatile. Now 1:30, and we will go by 5 minutes. Okay, friends, we are going to exit by 2 p.m. Okay, we reach the 2004 2 p.m. We have to exit. That is our rule actually. Whatever may happen. Okay, friends, 2400. We'll go to the next expiry. What is our next expiry? Is the 11th of May. When we are going to start on Friday. Okay, we have to clear this expiry. This thing. Friday 5th, we are going and we are starting at 14:45 as our usual time. It is not that you have to start exactly at 14:45 because after 2:30 anytime you can start before 3 p.m. Okay, friends. So the spot price is 42,900. The ATM is 42,900. We have to buy the ATM strikes, call and put, and we have to sell the out of the money in 2 ratio, 1:2 ratio. So 250 is the 125. This one, no, we have to sell these things, and here 300 is the 150. No, we don't have 150 here. This is also 130. It is 153 is coming, no, 153, 38 towards this we will sell here. Okay, friends, but 1:2 ratio we have to check before simulating our strategy. Okay, friends, this is our strategy. We'll start simulating. This is the Monday morning, 9:30. We are in the loss of 500 rupees. Monday, 1 minute back, 30 minutes. Okay, friends. We'll simulate by 5 minutes. 1 minute. Again, we'll back 5 minutes. 5 minutes. Okay. By 1 minute, we'll go 1 minute. So 42,000, 43,199. So at this point, we have to buy the call option of this 43,500. This break even 43,500. Okay, friends. This break even call we have to buy 43,500. Call we have to buy. Okay, friends. And we will simulate by 30 minutes. Whenever it crosses this break even, whenever our market crosses this break even, we have to exit the strategy. That's all. 30 minutes by 30 minutes. Simulate by 30 minutes. We are in loss of 700 by 15 minutes. It is on Monday, 3 p.m. Okay, friends, we are in loss of 700 rupees. We are in loss of 800 rupees. It is already crossed our break even 43,439. 43,395 is our break even. Okay, friends, it is because of gap up. We will check whether it may reverse no sometimes. We'll check another 5 minutes and we will close our strategy. Okay, friends, it's coming back. It's coming back to green area. Again, it's came back to green area. At that, whenever it's just crossed means, please just check for another 5 minutes. If suppose it may reverse, no, because it is in the morning. It is actually gap up. Sometimes in the initial time of gap up, sometimes it will reverse us back. So that we will check for 5-10 minutes, then we will close our strategy. If it is continuous going higher side, then we will close our strategy. Okay, friends, 5 minutes. 5 minutes. Okay, now it is again 395, 399. Again started. Again. Okay, friends. It is almost 407. We'll check another 1 minute. But it is started going higher side. See here. Okay. 391. Okay, okay. Check for We'll check whether it can reverse inside. $450. You can see here, friends, it is almost 50 points above the break even. Now it is the time to close our strategy. If any time you check the break even points, you check for 5 minutes or 10 minutes or 20 minutes. If it continuously going higher or lower, then close the strategy. If it is reverses, then you check for another 5 minutes, 10 minutes. If it comes inside, then continue. Otherwise, close the strategy. Okay, friends. Now 903, it is 43,450, around 50 points higher than our break even. Then we have to, this is the point where we have to close our strategy. Okay, friends. We are lost in 900 points, 900 rupees. We are lost in 900 rupees. So this week we booked loss. Okay, we'll go to the next week, friends. Next week is 18th May. We have to start our strategy on 12th. Okay, friends, we'll clear this. Yeah, date 12th, 14:45. What is the spot price? 43,857. 43,900 is our ATM. 43,900 is our ATM. Just we'll buy the ATM call, ATM put and ATM call. Exactly off of this 160 rupees. 160 rupees we will sell 2. Okay, friends. We'll modify this. Oh, this is 251 now. 125. Oh, 125 will. And we have to add one more cell here. One more cell here. Okay. This is our strategy. Now we'll start simulating our strategy by 30 minutes. Monday morning, 9:30. We are in profit of 700 rupees. Monday, around 10:30, we are in profit of 890 rupees. Monday morning, 11, we are in profit of 890 rupees. We have to observe whether it reaches to cliff. What is this cliff point actually? The cliff point is 44,000. This is 200. 44,200. And this is exactly where we sold our sell positions. That is this cliff point, 43,500. Okay, friends. Monday 2 p.m. we are in profit. Monday end of the trading day we are in profit. Tuesday morning we are in profit of 1100 rupees. Tuesday around 10 a.m. we are in profit of 1000 rupees. Tuesday morning around 11:15 we are in profit of 1600 rupees. Tuesday morning around 12:17 a.m. 1640 rupees. 1250, 1900 rupees. 2:20 p.m. We reached 2000. Profit is reached 2000 rupees. 2200, 2478 rupees. We reached our target actually. Okay, friends, 2655. We reached our target 2%. Okay, friends, this is our profit. The third week we got profit. First week and third week we got profit. Second week we are in loss. We will check what happens in next week. At 25th of May, we have to start on 19th of May. Okay, friends, we have to clear this. We have to clear this one. 19th of May, we have to start at 14:45 p.m. Okay, friends, the spot is at 43,884. 43,900 is our ATM. 43,900 is our. We have to buy the ATM put and call. 270, 135 nearby, 128, 135, 156. This is the nearby. Okay, friends, and 250 to 125. Okay, we have to change the ratio. 1:2 ratio. We have to buy. Okay, friends, this is our strategy. We start simulating by 30 minutes. Monday morning, 10 a.m. We are in the profit of 296 rupees. 12 p.m. We are in the profit of 600 rupees. We are in the profit of 750 rupees by 1 p.m. At the end of the trading hours on Monday, we are in the profit of 1250 rupees. Okay, friends. Tuesday morning, 9:40. We are in the profit of 1360. Tuesday morning, 11:40 a.m. We are in the profit of 1580. Okay, friends. At Wednesday morning, around 950. We are in the profit of 2800. We reached our target. That's why we are closing our strategy. Okay, friends. But we have to close our trade whenever we are completed almost 4 expiries. We are completed 3 expiries. We got profit. 1 expiry we lost around 900 rupees, I think. This break-even points, whenever it moves crosses the break-even points, immediately we have to close the strategy. We will check another for 1 or 5 minutes or 10 minutes. It is continuously going higher or lower to these break-even points, breaches these break-even points. Then we have to close our strategy. Okay, friends, this is range. If it plays within this range, only that time only we will get profit. So most of the times, actually this is very high range. You can see here 43,100 to 44,400, around 1,300 points range. Most of the times, Bank Nifty will be within this range only. Sometimes it may happen 1 or 2 times, sometimes monthly 1 time, sometimes it may go. That time we will uh, end up with minimum losses. You can see, even though it is breached the break-even point, we lost only 900 rupees. It may be around 1000, 1200, like that. Maybe when we are getting the profit, we will get 2%. Okay, friends, around 2400 we will get. Okay, friends, thank you, thank you very much. We'll check our ROE. Okay. Okay, friends, this is our ROE calculations. Last 4 expiries, you see here. 4th May, 2412 rupees. On 11th May, we got 903 rupees. 18th May, 2655 rupees. 25th May, 2804 rupees. Total, we are in profit of 6900, but our capital is 1,20,000. So our ROI is around 5.8%. In this strategy, we will get around 4 to 6% monthly on average. Every month we will not get 6%, 5.8% like that, but on average we will get around 4 to 6% for this one lot. If you use one lot. Okay, friends. Thank you. Thank you very much. Friends, if you think content in this video is useful and valuable for you, please like and share the video. And also subscribe the video to get further notifications for upcoming videos. Thank you.